Okay, next we move to the national income accounting, the definition, as well as the approach to calculate national income. So what is national income? National income, we refer to total income received by everyone or all economic agents in the economy, and this usually can be measured in terms of the goods and services produced in the economy. So the higher the value of goods and services produced in the economy, it indicates higher national income. Okay, and then in the calculation of this national income, there are a few things that you need to remember in terms of the items that you need to include and exclude from the calculation. First, when you calculate national income, in the calculation, we will only include final goods. Intermediate goods such as raw materials will not be counted because the price of this intermediate good already reflect in the final goods. So if you include the intermediate goods such as the raw materials, it will lead to a double counting problem. Number 2 is only first-hand item. Second-hand item should not be counted in the year national income because that transaction already occurred in the past. So for example, when you sell let's say your old car to your friend, and this transaction for this sales will not be included in the national income. Number 3, income from productive work, meaning that it should be a bilateral exchange, or if you work and you get the income from working, then that will be counted in national income. Transfer payment or a unilateral exchange will not be counted in national income. Example of transfer payments are donation, scholarship, and cash transfer money. So meaning that you get the money unilateral, one way only. Okay, for example, you receive the cash transfer money such as BRIM money, that is regarded as transfer payment, and it will not be counted in the national income. So to calculate national income, we have 3 approaches, which are the expenditure, the product, and income approach. So expenditure will count all expenditure made in the economy. Product approach will calculate the value of the goods produced in the economy, while the income approach will calculate all income received by economic agents based on the factors of production. So all represent national income but from a different approach, because one person expenditure will become the income for the other person, and the expenditure that you made in the economy will be based on the price of the goods itself. So the price or the value of the goods will also represent the national income. So either you spend the money to buy goods, or the value of the good itself, the price of the good itself, or the income that the person received, all will represent the national income, and the formula will also be different. So before we move to the formula for this expenditure, product, as well as income approach, you need to know the difference between the concept of GDP and GNP. So GDP represent gross domestic product, while GNP represent gross national product. So what is the main difference between these two concepts? Gross domestic product, okay, domestic. So gross domestic product, we refer to all final goods or total market of all final goods produced in the country, produced inside the country or within a country in a given period of time. while GNP we refer to total market value of all final goods produced by the nation, residents or nation citizens, regardless where it is being produced. So if you calculate everything, for example in Malaysia, whatever produced inside the country, the value of the goods and services produced, you count everything, it will represent gross domestic product, because you count everything inside the country, regardless who is the owner of that businesses. But when you calculate GNP, you will take into account only what belongs to the nation. So it means it's being produced by the nation, citizens, either in the country or outside of the country. Okay. So next, we move to the three formula to calculate the expenditure, product as well as income approach. So we start with the first one. To calculate the national income based on expenditure approach, the formula is C plus I plus G plus X minus M. And when you apply this formula C plus I plus G plus X minus M, we call this as GDP at market price. Remember the term GDP? GDP means whatever goods produced inside the country. So MP represent the market price, the value ataupun the price of the goods at the market. So what is C? C represent household consumption or household expenditure. I represent investment. G represent government expenditure. X represent export. Export means you sell your goods overseas. And M represent import, means you buy goods from foreign country. So this formula actually represent the expenditure made by all economic agents in the economy, consists of the household, the firms, the government, as well as the foreign sector. So this formula, when you calculate later, remember, if you cannot find the terms consumption, try to look for the terms expenditure. Okay. And then I represent investment. And besides investment, they can also use a different name for these terms, which is the gross fixed capital formation. So when you want to calculate your national income based on expenditure approach and you cannot find the name investment, then try to look for gross fixed capital formation. One more thing about this investment is you can also be given another item, change in stock or change in inventory. So you need to count that as well, because it is also part of investment. And then number 4 is the government expenditure. So if you cannot find the terms government expenditure, then try to look for public expenditure. Okay, if you are familiar with the terms public sector, so public expenditure represent the government expenditure. And then you have the terms export and import. So sometimes instead of giving you two separate items, export and import, so the question also can give you only one item, that is net export, means export that has been deducted for import. So either you can get you will be given two separate items, or you will be given only one item, and it will be named as net export or net import. Okay, next we move to the product approach. So for product approach, we don't have any specific formula because there are too many economic sector. So we use the formula all final goods and services, and when you count the value of all final goods and services, it will represent the gross domestic product at market price. So among the economic sector that I outlined here, agriculture, we have mining, we have manufacturing, construction, banking, tourism, government services, other services, transportation, communication, and others. So whatever the item representing the economic sector, okay, besides the one that being listed here, such as wholesale, restaurant, or whatever, as long as the item represent economic sector, then you count everything, and that will represent the gross domestic product from at market price based on product approach. And finally is the income approach. So for income approach, the formula is derived from 4 factors of production, which are the land, labor, capital, and entrepreneur. So the return for these 4 factors of production will become the formula for national income based on income approach. So for land, the return will be in the form of rent. For labor, the return will be in the form of wages or salaries or income from employment or income from self-employment. And then capital, the return will be in the form of interest or dividend. Finally, for entrepreneur, the return will be in the form of profit. So when you plus the return for the factors of production, it will become the formula for income approach. However, notice that for expenditure and for product approach, the first step will start with GDP at market price. For product also, it will start with GDP at market price. Only for income approach, it is already in factor cost. Why? Because the formula itself is being derived from the factors of production. Therefore, the figures is already in factor cost. So as a conclusion, or in short, for expenditure, you measure all expenditure made in the economy by the household, by the firms, by the government, and the foreign sector, and it will represent your national income based on expenditure approach, and that formula will represent the GDP MP at market price. For product approach, you total all the market value for all economic sector, goods produced in all economic sector. You measure all, it will represent the GDP MP, but based on product approach. While for income approach, you will take the return to the 4 factors of production, and when you plus everything, it will represent your national income based on income approach. And one special thing about this income approach is the value will already be in factor cost. So next we will see what will be the difference between the market price and factor cost. But before that, there are other formula that you need to know. So the first one would be the difference between GDP and GNP. Okay, so before this, I already explained to you what is the meaning of GDP and GNP. So I will repeat. GDP means whatever produced inside the country. Okay, the value of goods produced inside the country while GNP represent whatever produced by the nation's citizens, either inside or outside the country. So if you want to change or you want to shift from gross domestic product, how can you calculate your gross national product? You need to plus factor income received minus factor income paid, meaning that whatever you produce inside your country, and then you plus your income received from overseas, because some company or some people in your country might open business abroad, so the income received from abroad should be plus, and then you minus whatever belongs to other country, you will give in the form of income paid to the country, and this will represent the GNP. So GDP plus FIR minus FIP equals to GNP. Okay, besides that, later you can see in the table, instead of giving you separately two items, FIR, factor income received, and factor income paid, the question also can give you only one item, net factor income. Net factor income meaning that the factor income received that has already been deducted for factor income paid. So in that case, what you can do is you will take your GDP, you plus net factor income, and it will become the GNP. And this net factor income also known as net property income. So number 2, okay, this is the one that I'm telling you about, the market price and factor cost. So if you calculate the expenditure and product approach, the value will be in market price, okay, meaning that the value at the market, what you sell in the market. But factor cost meaning that the value at the supplier. So how can you change or move back from market price to get the value in the form of factor cost is you need to minus indirect tax and plus subsidies. So market price, the value of the goods at market price, you need to minus indirect tax and you plus subsidies, and it will represent the value at factor cost. So one thing that you need to remember about this indirect tax, sometimes instead of given to you the name indirect tax, they can be more specific or they can use a different terms, which are the sales tax, tax on expenditure, or tax on consumption. So if you cannot find the terms indirect tax, try to look for sales tax, tax on expenditure, or tax on consumption, because indirect tax refers to tax that enacted to you or tax that the burden can be shifted to the other person and normally occur when you buy goods and services in the market. Okay, for example, GST and SST is part of this indirect tax. And then if question asks you to calculate the net value from the gross value, what you need to do is the value in terms of the gross value, you minus depreciation and you will get the value in the form of net value. The formula number 4 is national income. So this is the most crucial part, the national income. The formula is gross national product at factor cost minus depreciation. So gross national product at factor cost minus depreciation. So if let's say the first formula that you use will give you the answer in the form of GDP MP or GDP FC depending on the approach that you use. For example, if you use expenditure approach, The first formula introduced just now said that when you apply the formula, then the value will be in the form of GDP MP. So from that first formula, how can you calculate national income? You need first to change the value in the form of GNP and also in the form of this factor cost, and you minus depreciation, then you can get the answer for national income. And this item depreciation, if you cannot find the terms depreciation, then you can look for the terms capital consumption, because capital consumption represent depreciation. And then formula number 5 is personal income. So personal income, the formula is national income plus transfer payment minus corporate tax, or also known as business tax, minus insurance premium, minus EPF, Employees Provident Fund, or KWSP, minus social contribution, or SOCSO, minus retained earnings, minus undistributed profit. So notice that to calculate your personal income, you must first solve your national income, because you need the value of your national income inside your personal income. So solve your national income, then the value you put under this personal income, and you will plus only one item, which is the transfer payment. Okay, if you still remember what is transfer payment, it is a unilateral exchange. For example, you receive a donation, scholarship, or cash transfer money, or you receive money from your parents, then that regarded as transfer payment. And then the other item you need to deduct from the calculation. And finally, the disposable income. The disposable income, or some reference books use disposable personal income. The formula is PPIT, personal income minus personal income tax.